All right, let's get right into it. Most of us think about taxes as a penalty, right? Something you just have to pay. But what if that's the wrong way to look at it? What if the tax code is actually more like a blueprint, an architectural plan that's full of incentives designed to get you to do certain things? Well, in this explainer, we are going to deconstruct the core mechanics behind building wealth in a tax-efficient way, piece by powerful piece. So here's the game plan. First, we're going to completely reframe how to think about the tax code's purpose. Then, we'll dive into the real estate engine and how it can generate some massive deductions. After that, we'll talk about the corporate shield for protection, explore some pretty advanced strategies for capital and legacy, and finally, we'll pull it all together to show you how this becomes one interlocking system. So let's kick things off with that really big foundational idea. Most people see the tax system as just a cost. You make money, you pay tax. End of story. But expert analysis shows that's only looking at half the picture. The real power comes from understanding why the rules are the way they are. And that really brings us to the core question here. Are we just supposed to follow the rules as they're written? Or are we supposed to interact with this system of incentives? The central idea is that the government has basically built a series of optional pathways into the tax code. Why? To get people like us, the private sector, to do the things it needs done, like providing housing for people. This right here illustrates the fundamental split in the system. On one side, you have mandatory rules. These mostly apply to employees, people earning a W-2 wage. But on the other side, you have these optional incentives. And these were designed specifically for investors and business owners, the people who take on economic risk. The government offers them tax breaks as a motivation to create jobs, build apartments, and basically keep the whole economic engine humming. Okay, so let's see how this actually works in the real world. We're going to look at one of the most powerful incentive systems out there, real estate. And the key mechanism here isn't what you think. It's not just about rent checks or property values going up. It's about something financial experts call a paper loss. So, the magic word is depreciation. And here's the crucial part. It is a non-cash deduction. That means you get to claim a loss for tax purposes without a single dollar actually leaving your bank account. The system lets you write off the value of the building itself, not the land, just the building, because on paper, it's an asset that wears out over time. Even if in the real world, its market value is skyrocketing. And this breaks down the process beautifully. It's just 3 steps. Step 1, you buy an asset. Let's say a building worth $1 million. Step 2, you get to deduct a piece of that value every single year. For a residential building, that's spread out over 27.5 years. And then step 3, that deduction, that paper loss, can be used to wipe out your taxable income. You're literally creating a tax shield from an asset that's making you richer. But come on, why wait almost 3 decades for those tax breaks? Well, you don't have to. Savvy investors use a technique called a cost segregation study. This lets them break the property down into its components, things like carpets, lights, appliances, and claim they have a shorter lifespan. The result? You get to accelerate your depreciation, cramming all those massive deductions into the first 5 to 7 years you own the property. It's a huge boost to your tax savings right up front. Now, this is where the strategy becomes an absolute game changer. See, under very specific circumstances, those paper losses aren't just for offsetting your rental income. If you can qualify as a real estate professional, or if you use a short-term rental strategy where the average guest stays for less than 7 days, you can use these losses to reduce the taxes on your main income from your high-paying W-2 job or your active business. Now, it's really important to understand that none of this works without a solid foundation. And that brings us to the corporate shield. We're talking about using business entities to build a financial firewall and unlock even more tax strategies. This table lays it all out pretty clearly. A sole proprietorship, easy to set up, but it offers 0 liability protection. An LLC, a limited liability company, that's perfect for holding assets like real estate because it gives you that strong liability shield. Then you have the S-Corp, which is often the best choice for an active business that's making, say, over 50 grand in profit, because it can help you save a ton on self-employment taxes. And this right here is the number one takeaway. An entity's first job is to protect you. By opening a separate business bank account and never, ever commingling your personal and business money, you make sure that if the business gets sued, your personal stuff, your house, your savings is safe. Without that firewall, a court could come after everything you own. Okay, so with our foundation in place, now we can look at the most advanced plays in the book. This is how you see true generational wealth get built and passed down with incredible tax efficiency. Some people call it the borrow, appreciate, die method. The entire system is really built on one simple imbalance. The tax rate you pay on your labor can be almost double the tax rate on long-term capital investments. This massive difference creates a huge incentive for investors to make their money from appreciating assets, like stocks or real estate, instead of just from a salary. So what does this cycle actually look like? Well, an investor buys an asset, they hold it for years, and it grows significantly in value. Now, instead of selling it and getting hit with a massive capital gains tax bill, they just take out a loan against the asset's new value. Here's the key. Loan money isn't considered income, so it's completely tax-free. They can live off this tax-free capital, and then, when they pass away, the asset goes straight to their heirs. And this is the final, mind-blowing piece of the puzzle, the step-up in basis. The tax code says that when an heir inherits an asset, its original purchase price, its basis, gets stepped up to whatever its market value is on the day of death. That means all of the capital gains that built up over the original owner's entire lifetime are just poof, erased, gone, completely tax-free. The cycle can then start all over again. So, we've looked at all these incredibly powerful tools one by one. But the real genius here isn't in any single piece. It's how they all assemble into one cohesive, self-reinforcing system. Let's just walk through the whole sequence, from start to finish. First, you create that corporate shield, an LLC, for protection. You use that LLC to buy appreciating assets, like real estate. Then you use depreciation, ideally accelerated depreciation, to generate huge paper losses. You leverage those losses to wipe out the taxes on your active income, which drastically cuts your tax bill today. As the asset grows in value, you tap into that wealth with tax-free loans. And finally, you pass that wealth to the next generation, where the step-up in basis wipes the entire tax slate clean. Which leaves us with one final thought. When you look at it through this kind of analytical lens, the tax code really starts to look different. It's not just a bunch of rules you have to follow. It's a complex system of incentives, a financial architecture with very clear pathways built into it. So the real question isn't whether the system is fair or not, but whether it's a trap for the people who don't know the rules or a roadmap for the ones who do.